Silver didn't drift lower. It dropped fast, briefly down about 36% at the worst point of the plunge, and then it rebounded with the kind of snap that only appears when leverage and liquidity collide. Gold, the asset people call the calm in the storm, also lost its composure, sliding from above $5,500 an ounce toward roughly $4,405 in the same shock window. Moves like that break normal expectations, because we are told deep markets do not behave like trapdoors. Not months, not weeks, in 48 hours. And the most important detail is not the candle. It's what the candle implies. Someone somewhere was forced to liquidate, and someone else was waiting to absorb what got dumped. Here's the uncomfortable part. When price behaves like that, it's rarely the crowd causing the first fracture. It's usually the plumbing. The institutions that live inside the plumbing see stress before it shows up on a chart. They watch inventory ledgers, delivery requests, collateral haircuts, and clearinghouse margin math. By the time the average headline says silver crash or gold volatility, positioning has already been adjusted, collateral has already been posted, and forced sellers have already been shaken out. The public sees the outcome. The system operators saw the pressure build. What I'm about to lay out isn't a conspiracy story. It's a pattern story. It's about how gold and silver can look abundant on paper while becoming scarce where it matters. Deliverable form, in the right locations, under the right rules. It's about why China's behavior matters, not as a slogan, but as a measurable set of actions that changes flows. And it's about why this moment feels like an endgame, not because someone wins, but because the system keeps drifting toward a point where paper claims and physical metal have to reconcile in a very public way. Welcome to Signal and Noise, where we decode what matters before it becomes the headline everyone repeats. We don't chase emotion. We trace incentives, rules, and data. If you're new, settle in like Younes. We're listening to a wise elder who has seen cycles repeat with new costumes. And drop a comment with where you're watching from, because the metal story looks different, depending on whether you're near a refinery, a vaulting hub, a manufacturing base, or just a trading screen. Now, what actually happened? In the first days of February 2026, the metals complex broke character. Silver's drop was too sharp, too fast, and too synchronized with funding stress to be explained by a single neat narrative. A market can fall 10% on fear. A 36% intraday shock is something else. It smells like forced liquidation, margin calls, risk limits, and cascading sell orders that are indifferent to fundamentals. Gold's move echoed the same dynamic. When gold drops hundreds of dollars in a compressed window, it's often because gold is being sold to raise cash to cover losses elsewhere, or to meet collateral demands inside a portfolio that can't be rebalanced gently anymore. The central mystery is simple to state and hard to ignore. If metals are in an era of strong demand, persistent deficits, and official sector accumulation, why would silver implode and gold wobble at all? Shouldn't tight supply mean steady, rising prices? That's how people imagine markets. But real markets are layered. There's the story layer, where narratives live. There's the leverage layer, where futures, options, and swaps amplify moves. There's the collateral layer, where cash and margins settle obligations. There's the inventory layer, where deliverable metal sits in specific vaults, subject to specific rules. And there's the time layer, where it might take days or weeks to convert, move, and settle physical supply, even when the screen price changes in seconds. To see why February 2026 matters, you have to recognize the historical rhyme. In 1980, silver didn't just rise, it sprinted into a frenzy and then broke when rules and liquidity changed. People remember speculation. The part that matters is the rulebook, margin requirements, position limits, and how quickly credit can vanish when volatility spikes. In 2011, silver again ran hot, reaching the neighborhood of $50, and then it rolled over. It tracked a tightening of risk tolerance and a market structure that could not support the same leverage at the same price once volatility rose. And in each case, the story told afterward is simpler than the mechanism that actually did the damage. Then consider 2020. In March 2020, it wasn't a metal story at first. It was a collateral story. Everything that could be sold was sold, including assets people assumed would behave as havens. The point was cash. The point was margin. When funding markets strain, price can detach from the narrative for days or weeks, because the narrative does not settle trades. Collateral settles trades. That episode taught a lesson that keeps returning. When liquidity is the constraint, fundamentals take a backseat, and the market becomes an auction for whoever can meet obligations fastest. Now bring that pattern into 2026. The ingredients look familiar, but the backdrop is different. Silver demand has been structurally strong, not only in jewelry or investment coins, but in industry. 5 million ounces. That's not a niche hobby market. That's a critical input market tied to electronics, solar, and broad manufacturing cycles. A persistent deficit doesn't force price up in a straight line, but it does make the system more sensitive to shocks because the market is relying on stocks, recycling, and substitution to fill the gap. Gold has a different pull, but it is just as structural. 15 million fine troy ounces as of December 2025, roughly 2,306 tons. That figure matters less as an absolute number than as a behavior pattern, consistent accumulation. Over many months, signals a strategic preference to convert part of reserves into an asset without counterparty default risk. Official sector buying doesn't guarantee higher prices next week, but it does matter for market structure, because official holders are not typical traders. They are slow, persistent, and rarely forced sellers. Here's where it gets interesting. At the same time that official and institutional interest has been visible, the physical stock that underpins global pricing sits in a few key nodes. London is one of the biggest. At end December 2025, the London vaulting system reported about 9,106 tons of gold and 27,218 tons of silver in its vault network. Those are enormous numbers, and they create a dangerous illusion. Must die. But inventory is not the same thing as free supply. Some metal is allocated. Some is pledged. Some belongs to entities that do not lend. Some is in a form that is technically present but practically unavailable at today's terms. This is the dislocation. Headline stocks versus deliverable stocks. Paper markets can trade enormous notional volume with minimal physical movement because most contracts are offset before delivery. That is normal. Settlement is where the hidden game appears because settlement forces the market to reveal whether paper claims are matched by metal that can actually move at the scale implied by trading volume. When the market is calm, this rarely gets tested. When the market is stressed, it gets tested quickly. So let's talk about the players, because the market is not a single creature. You have futures exchanges and clearinghouses that set margin and guarantee settlement between counterparties. You have large dealers and bullion banks that intermediate between miners, refiners, industrial users, and investors. You have vault operators and logistics firms that move bars from one jurisdiction to another. You have refiners that convert raw material into standard formats. You have large funds that trade exposure, often with leverage, because leverage is how they target returns. And you have official institutions that treat metal as reserves, meaning they measure time in years, not sessions. When volatility spikes, the clearing system reacts. Margin is not a moral judgment. It is a survival mechanism. If prices can move 30% in a day, the system must demand more collateral, because otherwise it risks default cascades that can tear through the entire chain. But that reaction has a side effect. It forces leveraged participants to either post more capital or reduce exposure. Most reduce exposure. That selling pressure becomes self-reinforcing, and the cascade does not care whether silver demand is rising or whether central banks are accumulating gold. The cascade cares about meeting obligations. Now add the difference between gold and silver. Gold is largely monetary and investment driven, with deep liquidity and a large above-ground stock. Silver is both monetary and industrial, with a smaller above-ground stock relative to yearly usage and a higher sensitivity to leverage. In liquidation events, silver often behaves like high beta. It falls harder and then rebounds faster because it is the first place leverage gets cut and the first place value hunters return when forced selling exhausts itself. It makes silver more sensitive to how the system is financed. So why focus on China in a story about margin and settlement? China is also a manufacturing and refining hub and a major participant in physical metal flows. When a major economy steadily accumulates gold in official reserves while also pulling in metal through commercial channels, it changes the direction and the stickiness of supply. It matters whether metal is moving east or west. It matters whether it is being turned into long-term holdings, strategic inventories, or industrial feedstock. Even if public reserve figures capture only part of the picture, the behavior pattern itself is the point. A steady preference to hold metal rather than paper promises changes the balance of what is available to lend and what is available to deliver. Markets are moved at the margin. If a portion of metal that used to circulate through leasing and swaps becomes less available, the system can look fine until it suddenly doesn't. Paper claims can expand faster than metal can be mined, refined, and shipped. It's like a theater that sells more tickets than seats because most people never show up at once. Usually, that assumption holds. In stress, it is tested. And when it is tested, the question becomes who shows up demanding a seat and who can persuade them to take a voucher instead. Now consider the contradiction that defines the endgame feeling. On one hand, the screen shows silver able to drop by a third and still find buyers. On the other hand, long-term data shows deficits and dependence on inventories. Those truths can coexist only because the paper layer can overwhelm the physical layer in short windows. The paper market sets the reference price, but the physical market determines whether that price can be honored when people insist on delivery, allocation, and immediate settlement. This is the part no one is discussing. The metal does not have to run out for scarcity dynamics to matter. It only needs to become unavailable at the margin. If most bars are tied up in allocations, industrial commitments, or long-term holdings, then the free float is smaller than the headline stock. Small disruptions can create large premiums in specific products and locations. Those premiums might not show up immediately in the main futures price. They can show up as wider spreads, delayed delivery windows, and a rising cost to borrow metal. And you can see hints of this in quiet data points that rarely become headlines. On February 2nd, 2026, daily delivery notices in the U.S. futures ecosystem showed hundreds of contracts moving toward delivery, including 639 gold and 251 silver in that snapshot. On its own, that is not a collapse. But in context, it is a signal. Delivery interest matters more when volatility is high because delivery demand turns paper exposure into a physical obligation. When that demand stays elevated during stress, it tightens the system at the exact moment the system is trying to reduce risk. Here's where it gets interesting again. The dislocation is not just paper versus physical. It is also location versus location. A bar in the wrong place is not a bar you can settle with today. Logistics and rules matter. Refineries produce specific bar sizes. Vaults accept specific standards. Financing terms and shipping times determine whether metal can move quickly. During calm periods, the system arbitrages those differences smoothly. During stress, frictions increase. Suddenly, a local shortage can exist even while global inventories look large, simply because the metal cannot be mobilized fast enough or cheaply enough under the current rule set. This is also why experts can sound like they contradict each other, while both are describing something real. One expert looks at the futures tape and says there is plenty of liquidity, because volume is high and the market keeps trading. Another looks at physical availability and says the market is tight, because delivery times lengthen and premiums rise in certain products. Both can be right, because they are looking at different layers. The paper market can be liquid while the physical market is constrained, and the transition between those layers is governed by settlement rules, collateral costs, and the willingness of holders to lend. Now, the mechanism that turns that constraint into a price event is not mysterious. It is executed through margin math, collateral calls, and forced selling. A volatility shock hits. Margin requirements rise. Carry trades become expensive. Dealers widen spreads. The cost to roll futures positions increases. Some participants choose to cash out rather than refinance. Meanwhile, entities with strong balance sheets can absorb metal because they can survive the collateral environment. Stress events tend to transfer assets from leveraged hands to well-capitalized hands. That is the hidden transfer that often follows violent price action. Think of it like a bridge during a storm. When winds rise, authorities restrict traffic. Smaller vehicles turn back. Only heavy trucks with permits keep moving. And the bridge is the market. Margin is the wind restriction. And the metal is the cargo. The storm does not create the cargo. It changes who can transport it, who is forced to unload it, and who can afford to wait until the storm passes. In many systems, not all inventory is available for immediate delivery against futures. Some is eligible but not registered. Some is allocated to specific owners. Some is pledged as collateral. Some is in a form that requires conversion. In stress, the availability of registered deliverable supply becomes a focal point, and that availability can change quickly if owners decide not to make metal available at current terms. This is how the market can look well supplied on paper while feeling tight to anyone who needs specific metal now. When that happens, the paper market can still trade, but the cost to source physical metal can rise relative to futures. Over time, that gap cannot persist indefinitely. Arbitrage either closes it, or arbitrage breaks down because constraints are not purely financial. Logistics, regulatory frictions, financing costs, and simple refusal to lend can disable the smooth closing of spreads, turning what looks like a temporary mismatch into a recurring feature. So what does the evidence suggest beyond the crash itself? 9 million ounce shortfall that implies the market is leaning on stocks, recycling, and substitution. That can persist, but it makes the system sensitive. 15 million ounces by December 2025. Add the concentration of vault stocks in major hubs like London, and remember that those numbers represent presence, not necessarily availability. Together, these data points describe a market where a meaningful share of metal is becoming more sticky, less likely to circulate in ways that make paper settlement effortless. Now add the behavioral tell from February 2026. Silver did not fall and then stay broken. It rebounded. Violent rebounds often indicate forced selling rather than a slow shift in demand. They suggest that liquidation, not a change in the long-term industrial picture, was the driver of the most extreme move. They also suggest that there is underlying bid interest that waits for liquidation events. Larger players understand that volatility is a transfer mechanism. They do not need to predict the exact day. They need liquidity and a plan for how to acquire exposure when others are forced to exit. One more layer makes this episode feel different from an ordinary washout. The metal that matters for settlement is increasingly treated as strategic, not just speculative. When official institutions add gold to reserves, that metal tends to become less available to the lending pool that supports day-to-day market making. When industrial users lock in silver supply through long contracts, that metal also becomes less available for just-in-time delivery when paper positions suddenly demand it. In calm markets, these shifts hide in the background because trades are rolled, offset, and netted. In stress, the shifts become visible because the market discovers how small the true free float can be. This is why veterans repeat a simple phrase: the market is not one market. There's a screen price, a wholesale physical price, and then there is the price of metal that can actually be delivered right now, in the right bar size, in the right vault, under the right paperwork. When those prices diverge, something is being rationed, usually not by decree, but by cost. And this is why a crash can coexist with accumulation. During the February 2026 shock, the selling pressure was largely about meeting collateral demands. At the same time, longer-term holders were not required to sell. Some were positioned to add exposure precisely because they had liquidity when others did not. The weak hands sell claims. The strong hands, who can take delivery or hold allocated positions through volatility, gain relative ownership. Notice what this does to the psychology of the tape. In calm times, price is treated like truth. In stressed times, price becomes an auction for liquidity. The strongest bidder is the one with cash, collateral, and patience. That is why the biggest moves often look irrational to newcomers, but perfectly logical to clearing desks. If you want a practical way to watch this without drowning in noise, focus on signals that reveal stress before headlines do. Watch whether delivery demand remains elevated after volatility fades. Watch whether physical premiums stay firm even when the futures price retreats. Watch whether financing signals like lease rates or the cost of carry rise even during calm periods, because that can indicate that metal is becoming harder to borrow. Let me show you what this means going forward without turning it into prophecy. Historically, when you see persistent deficits, heavy industrial pull, and repeated episodes where paper selling overwhelms price temporarily, the next phase tends to fall into three broad scenarios. The conservative scenario is normalization. Volatility fades, margins stabilize, and price discovery returns to a range while inventories adjust quietly through recycling and incremental supply response. The moderate scenario is extended dislocation. Paper and physical signals diverge more frequently. Premiums appear in certain products or geographies. Delivery demand becomes more important as a market signal than futures volume. The aggressive scenario is a regime shift in which repeated stress events reduce the willingness to lend metal, making paper claims less elastic and making each shock more consequential than the last. Which path becomes dominant depends on indicators you can actually observe. Watch volatility in the collateral environment. Watch for unusual delivery demand relative to typical norms. Watch for persistent physical premiums that do not quickly arbitrage away. Watch for shifts in the cost of leverage, because leverage is the accelerant. And watch official reserve behavior and broad trade flows, not because they dictate tomorrow's price, but because they shape the long-term availability of metal in the lending pool that makes the paper layer feel effortless. This is why the endgame framing fits. It is not that someone flips a switch and the market ends. It is that repeated stress tests concentrate ownership and reduce lending elasticity. The more metal is held by entities that value it as reserves, strategic inventory, or industrial necessity, the less responsive supply becomes to price changes. And the less responsive supply becomes, the more fragile the paper system becomes during shocks, because the paper system relies on the assumption that claims can be rolled indefinitely under stable collateral terms. The divide, then, is not between optimists and pessimists. It is between people who understand settlement and people who only watch price. The screen tells you the last trade. It does not tell you who is willing to deliver, who is demanding delivery, and what collateral terms will be tomorrow morning. Institutions moved first in this story because they operate where those terms are enforced. Retail moves later because retail is downstream of the mechanics, learning after the fact why the chart behaved the way it did. So, when you see silver plunge and rebound and gold whip through levels that would have sounded impossible not long ago, treat it as a message from the plumbing. The data is suggesting stress and adaptation in real time. Metal is being pulled off the market, not by drama, but by margin math, by changing incentives to lend, and by long-term reserve behavior that slowly reduces the free float. That's why the short-term chart can look like chaos, while the long-term structure tightens underneath it. This is signal and noise, where we decode what matters before it becomes the headline everyone repeats. If this connected dots you hadn't seen, you know what to do. The question isn't whether this system keeps getting stress tested. The question is whether the next stress test finds the paper layer and the physical layer closer together or further apart.